This interview is brought to you by Foord Asset Management. Rashaad Tayob is with us in studio. Rashaad, lovely to be talking with you today. You guys had a webinar a little while back where you got together some of your portfolio managers, and I presume that you charged everyone with saying, what's going to happen in 2025? I mean, that's a little bit of a hospital pass, I guess you could say in the rugby parlance. But what was the purpose of this?
So we started last year. So we with the concept where we wanted to give our clients an overview of what our expectations were for the year ahead and how we were positioning. You obviously don't want to necessarily make any precise forecast, but you want to understand which way the world is going, which direction, and what are the risks out there. So, what we did last year was we said, what's in store for 2024? And we came up with a number of predictions, which the market expected to be low probability events, but we thought there was a higher chance than expected. And to our credit, I think we mostly did a good job in terms of those predictions of the gold price, some of the recovery in SA equities. So we obviously said, okay, it worked out last year, and in getting these predictions right, why not do it again and force the portfolio managers to go out on a limb? And we said how to thrive in 2025, and we tasked everyone with saying, what are you doing in terms of your portfolios to thrive and make sure the clients are going to do well next year?
Okay, well, congratulations on making some calls last year, but I'm sure you know about Nassim Taleb's view on predictions and fooled by randomness. I remember one of the big things that came out to me was that and those who don't know, Nassim Taleb is a great author and was himself a hedge fund manager and is revered in the investment industry. He called the great global financial crisis when pretty much no one else did. But he spent a lot of time as a young portfolio manager checking out people's predictions into the future, and he discovered that most of them were wrong. So you guys have got a 100% record from last year, putting it on the line. But I guess it's always good to exercise one's minds about what could be in store for us. And let's start with your own one, because that's a pretty controversial one. You reckon inflation's going to come back in a big way. Just take us through your thinking.
So obviously, 2024 has been a year of disinflation. There's a global rate cutting cycle going on. The SARB, cut last week. The Fed has basically started cutting as well from the middle of the year. So in an environment where inflation is moving back towards target and looks to be moderated, and in this cutting cycle, why do I say inflation could roar back in 2025? And I think that the reason is that the environment that we saw in 2021-22, where we saw inflation spike to multi-decade highs, the factors that drove that high inflation are likely to reappear in 2025. And what do I mean by that? In 2025, we were primarily driven by supply constraints, and that was the shutdown from COVID and the issues that you had there. You saw the cost of shipping spike. All those type of supply constraints happened. You saw fiscal stimulus on a massive scale, whereby checks were handed out in the developed world. If you look at what happened in the US, personal income actually went up 30% year on year at one stage. In a recession, which is just totally unprecedented, you saw incomes rising in a recession. That's never happened before. And then lastly, monetary stimulus was the third factor driving it, where you saw the Fed's balance sheet increase by almost $1 trillion a month at one stage. Massive monetary stimulus. And when you look at those three factors, I think all of those have the chance of reappearing as we head into 2025. Let's start with monetary stimulus. We don't necessarily have QE, but we've got synchronized rate cuts, which is easing of monetary policy. So that's happening. Secondly, you've got fiscal stimulus, which the spending habits that were that we got into during COVID, governments have just struggled to break their spending habits. You look at our fiscal deficit, still stuck close to 5%. The US has a deficit of close to 7%, close to $2 trillion in an environment where the unemployment is close to a record low, and you've actually got growth at a reasonable level. And you still have this massive deficit. So overspending is still a problem. And then finally, on the supply side, I'm seeing two factors here. You've got a potential trade war where you've got tariffs constraining supply. And then you've also got the potential for this the excess immigration to flatten out or even reduce, where in the case where Trump really follows through aggressively in terms of deportation. So one thing that's helped the US in terms of moderating inflation from the 9% level back down to the 3% level is the fact that the tightness in the labor market has been offset by excess immigration. You've had 10 million people come across the border illegally during Biden's term, plus the legal immigration. That's helped to control wage growth, which has helped with inflation. But if you stop that or even reverse it, you've got the supply constraint with labor. So when I look at the three factors that drove inflation, I think those three factors have a good chance of materializing into next year. And that's why I'm thinking inflation could definitely surprise on the higher side.
So Donald Trump comes with lots of risks attached. I suppose on the other end, you do have Elon Musk, who's going in for his Department of Government Expenditure cutting. Do you think that's more hype than reality?
So when you have people like Elon Musk, Vivek Ramaswamy, JD Vance, these are very intelligent, non-political type of people who are very focused on reducing the intervention, the regulation, and the level of government spending, which the US has needed because it has gotten out of control. And when that happens, you lose the dynamism within your economy. If you look at South Africa over the last decade, I think one of the reasons we've stagnated and grown by less than 1% per annum in per capita terms gone backwards is because we've got this belief that government is the one that should be driving growth and not enough of an acknowledgement that it's the private sector which drives growth and government should facilitate that. And the mistakes that we've seen over the last decade, I mean, I see them happening in the UK now in terms of the budget that they recently delivered. So I think that the US has a shot of turning this around. But I mean, these are massive systems, they're complex systems. And when you try and poke a complex system, as Taleb will tell you, things can happen which you can't necessarily predict. And a lot of the government spending that happens is effectively non-discretionary. So when you look at the government spending of 7 trillion, around 5 trillion of that is non-discretionary. It's social security, it's Medicaid, it's healthcare. And I think there are savings to be had. The healthcare costs in the US are amongst the most wasteful and overpriced in the world. If they can make inroads into that, I think it will be a massive positive. But when you've got 5 trillion of non-discretionary, discretionary, and only 2 trillion of discretionary, the amount that you need to cut on the discretionary side is immense. And I think they'll find it a lot more difficult. So while do support that initiative, I think that turning around a ship the size of the US government is going to be a lot more difficult than they anticipate.
No doubt. Absolutely no doubt. But the hype is there at the moment, and I suppose everybody's excited about it. Your colleagues had some interesting thoughts as well. So we've touched the one, which is inflation going up. I suppose before we move off that, what are the implications then of a roaring back inflation? Good for gold, good for Bitcoin, good for who else?
Yeah, so I think one of the risks there is that you have issues in the government bond market into 2025. So bond yields in the US are above 4%. When you look at the interest cost, it's gone from 300 billion a year to over a trillion. It's a massive increase in interest costs. As a proportion of revenue, it's actually up to around 20% of their total revenue, which is a very costly burden. In fact, in South Africa, it's a similar level where we got
Mm.
20% of our revenue just going to cover interest costs. So I think the US has benefited from the fact that while they were building up this debt from the financial crisis from around the 50-60% of GDP to 120. They did that in a very low interest rate environment. You now in a period where interest costs are ratcheting up and they're now facing this high debt burden, but with high interest rates. And at some point, there's a risk that the bond market can't actually absorb that, especially if you have inflation coming back. And inflation has come down from 9 down to around the 3% level. It hasn't gone back to 2, but now you stimulating again. You got monetary policy stimulus, you got fiscal stimulus. If you have inflation go back to 4% or even 5, then maybe people don't want to buy bonds at 4% again and maybe at 5 or 6%, but that just makes the interest burden even worse. So I think there's a risk that the bond market has a bit of a dislocation, maybe a Liz Truss type moment where the bond market just loses faith, and then the Fed needs to come in and backstop the bond market again. And I think that will be the trigger, which will be very good for gold, Bitcoin, real assets, etc. The point at which the Fed is forced to come in and backstop the bond market.
We live in very interesting times. Defensives, not surprisingly, a theme, will outperform in the USA. Now, defensives are what?
So Brian Assis, one of the portfolio managers in Singapore, made the case that utilities and regulated utilities, specifically electricity, are offering very good value at very attractive valuations, and they have a very steady growth path in an area where they need to spend money. So, in terms of the electrification of the economy, we know in South Africa we have to spend money in increasing the grid. It's a similar situation all over the world, including the US, and where you can find these type of regulated utilities where the capacity has to be increased, the amount of electricity that has to push through the system has to increase on a consistent basis as we electrify the economy, and they've got effectively monopoly power. You can find uh, you're not going to get 20-30% earnings growth, but where you can get high single digit earnings growth, which is reliable on a good multiple. He's arguing that those need to be a core part of a defensive type of portfolio, as opposed to stocks on 40-50 PEs, which are far more risky.
So you've had the run in the go stocks. Now it's time to perhaps consolidate. Is that the real message?
No, I think a portfolio has balance, and increasingly we're finding better value and more balance in allocating more to the safer portion of the portfolios with more reliable earning streams and more attractive valuations.
I guess that's not that controversial because it doesn't take a genius to work out you can't keep growing at the rates that the American market's been growing. But the next one is interesting. China will be one of the best performing markets in the world. There's a lot of cynicism at the moment about China and its stimulus package not being enough for that. China is actually falling off the radar. It's got a lot of fixing up to do before it gets back into a growth path. But you're looking at it differently.
So this is from Ishrat, another of our portfolio managers out in Singapore, and he actually predicted the same thing last year. So he's sticking to his guns. And in fact, a month or two ago, when China had moved to the top of the pile on the year-to-date returns, it looked like he was quite on point. But he still thinks that this recovery has legs. We've had many years of consolidation in China. The sentiment is at a low, and that's what leads you to these very attractive valuations for what we believe are world-class companies. And when you compare them to your options in the US, where for the world-class companies, for the leaders, you are paying extremely high multiples. In the EM space, if you want leaders in India, for example, you're paying very high multiples, whereas you can find that in China, at very world-class companies at attractive valuations. We also think that the government has been through a process of consolidation. The property sector uh, has the moves that have happened and the policies that have come in the property sector. They didn't come in last year. They've been in place since 2017, 2018. So that's already gone through a process of consolidation. And the monetary and fiscal stimulus in terms of delivering the turnaround, while maybe not of the quantum that people are clamoring for, we definitely think that it is sufficient and it will be sufficient to drive a recovery through. So when you look at that combined with the attractive valuations, we think that we are at a low point in sentiment, and that's what's giving you the opportunity to buy into to the Chinese market for 2025.
You got a big advantage at Ford to have a team in Singapore. I guess that also gives you a better vision or better view on what's happening in the big giant just to the north of there. So those are interesting insights and need to be taken very seriously.
I think that's been critical because if you look at the effective Cold War that's happening between the China and the West, the reliability of information that you get coming from Western media outlets, even the outlets like The Economist, like the Financial Times, you can see the shift in coverage and the way they're covering issues related to BRICS, related to Russia, related to China. It's coming from a very Western perspective of what's going on, and they've almost picked a side, and they've lost some of their objectivity. So when we've got a number of Mandarin speakers, Chinese, we've got people from all over the world in our Singapore office, but we are right on the doorstep of China, and we've got a number of Mandarin speakers in the team who've got family in China, and they understand it. They travel there regularly, and they understand it from the ground up. And I think if you speak to anyone who's been to China in the last year or two, there was we had our trip to China for clients earlier this year. They were you and I've spoken to people who've been there in the last few months. Anyone who's been there is actually just blown away. The gap between what the media's perception is and what you see on the ground is just massive.
It's an interesting point. Another one of our partners, our business partners at BizNews, is Korean. And David Bacher from Korean also had a trip to China and came back with exactly the same input, that it is a big surprise when you come from a country like South Africa, where we do, they're our partners, the FT and The Economist. We do get their inputs into the way that we think. But when you're in Singapore, it's on your doorstep. You see things very differently, and it's not a big surprise when things happen. So, great input there. The number four of the five was it's a minefield. If avoid the landmines. Now that sounds a bit like apple pie and what do they say in America? What happiness and apple pie, and anyway, but pretty obvious. But I guess it's becoming more and more relevant right now.
Yeah, so that's Vim Murray, one of our equity portfolio managers, is talking about not just focusing on where you're going to get your upside returns for, but also trying to avoid companies with poor fundamentals, which may not necessarily be uh, viewed from the earnings perspective. Don't just focus on the earnings, because sometimes when business models are structurally damaged, you find that earnings are overstated, and the capital that's required to continue operating is coming through below the line, and therefore they never return that invested capital back. And he gives historical examples of something like a Nampak, maybe examples of the last few years, like we've seen in a Sasol, where the maintenance capex is so large that the earnings are not necessarily a reflection of what's going to be due back to you to a shareholder. So avoiding some of those broken type of business models and protecting clients' capital in that way is as important as looking for the winners next year.
Brilliant, brilliant.
Mm.
Sassel, seeing the share price go further and further down, has remained to me with a different mindset, different set of spectacles, a wonderful opportunity. But the point that you make here is very on point. You only have enough free cash flow to give to shareholders once you've paid the maintenance, and if you've got a broken model,
Yeah.
interesting. Moving on to hospitals, that's an interesting one, especially in a South African context. We've got some very professionally and well managed hospital groups here in Netcare, Life Healthcare, and Mediclinic, but a view that this is a sector that could be poised for very good growth will be one that not everyone would have thought of given the national health insurance, which is also poised to be fested on us.
Yeah, so this was put through by our CIO, Nick Balkan, and I think his first thing was to basically explain what potentially NHI could be, because I think this word is thrown around almost daily in our newspapers, and I don't know whether people truly understand what the potentials are and what it could be. Effectively, the government is partly to blame for that, because we do have government hospitals. So we've got NHI. So what is this new thing that you're coming through with? But effectively, it is a funding mechanism to try and bridge the gap between the level of quality in the government hospitals and the level of quality in the private sector. Some would argue it's a bit of an insurmountable gap given the income and population dynamics within the country, but they are intent on doing something with it. The question is how you go about it, given that the potential cost is probably in excess of 200 billion, and we don't necessarily have the financial or people resources in order to deliver what they're claiming. So a little bit of electioneering there. And I think once we've gotten over the hump of the election, I think there has been some positives in terms of the political the developments and the working together with hospitals and the medical aids and what could transpire. I think the argument is that hospitals are you could there's two potentials with NHI. They could keep the medical aids in place and just basically raise extra funding and allow people to move and use that to get more people from the public back into the private sector, or they could effectually take over the medical aids, which means that you have a single payer type of system. But in either case, the hospitals are not too badly off, because they have a greater level of the population which will want to access private healthcare funded by the government. And that means that your occupancy levels, which are still below COVID levels, still in the sub 70s, have the potential to be increasing continuously and maybe getting back to an 80 to 90% type of level, which can only be good for the hospital industry. So we're not claiming that an aggressive move on NHI is going to be good for the population and the taxation levels and potential immigration issues. But from a hospital perspective, they potentially having more customers. And from a positive perspective, we are seeing more um, communication with the medical aids, with the presidency, with the hospitals, and you could have a very good situation for the medical industry, whereby they come up with a compromise solution where they've just pushed through more people into the medical aid sector. So they basically say anyone in the formal sector has to join a medical aid. You get another million people into the system, you get more money into the system, and you also get people not having to use the private sector. So you take some of that pressure off. So there could be compromise solutions which could work a bit better from an extreme solution, but will still be good for the hospital industry and have more money flowing into the healthcare sector.
So it's applying second level thinking on a very first level thinking narrative that we're seeing at the moment. Rashaad Tayob is head of fixed interest and a portfolio manager at Foord Asset Management. And I'm Alec Hogg from biznews.com.